So this onboarding is like 10 pretty basic questions. We can do it on the fly. It doesn't need to be perfect. These first intro questions, just statements, just explain that FlowCog takes the onboarding questions, generates a company persona for you based on the size and maturity of your company, and then fills in all of the default inputs based on the SaaS industry and based on kind of what a standard company of that size and maturity would have for any of the given inputs. So this kind of describes that to the user. Same thing for your balance sheet and your P&L. Historical, you'd go in and then update or integrate. I have a QuickBooks integration as well. So you could do that, but you would eventually try to enter in those inputs to get more accurate historicals and then have the continuity of the historicals in your projections.
Do you want me to actually like do it share the screen? Am I going to need to put some data or stuff like this?
You will, but I mean, I can enter it on my end.
Whatever's easier.
Yeah, why don't you tell me and I can enter it on my end just because
that's fine.
I didn't think to give you access.
No, it's all good. Okay, so it's 195.
So 1.95?
Without, you added an extra zero.
195.
Yeah.
Okay,
Yeah,
that's the ARR. Current cash balance.
It's really hard for me to say.
Let's say we can enter in some estimates too, and then always like change them later.
So
like let's say like 100 grand.
Yeah, I guess something like this.
Okay, and this is for NotionForms.
So again, it's kind of hard. So like I do have a full-time employee, but like I'm working personally on like 3 projects, and the guy I'm working with also work with me on these other projects. So I'd say both of us, we're not like full-time on it, like even combined. So maybe we could say like 1.
Okay, so I'll make the argument, let's do 2 for now, and then we can always cut the salaries down that it generates. So I'm guessing you don't have any, well, if you just have one other person, they're probably helping you build it and they're not a sales person.
It's just a dev.
Okay. Number of current paying customers.
872.
6 months ago, how many did you have? About, you can estimate if it's...
I can find it. Okay. So wait, 6 months ago is what months? May. That's 574.
Okay. How many pricing plans or tiers do you have?
So it's freemium and then 2 plans. So I don't know, either 2 or 3, depending if you count freemium or not.
Yeah. So the way we could do this a couple different ways in FlowCog. One way would be to have 3 separate pricing tiers. You zero out the deal size in the lowest pricing tier. Another kind of way to do it would be to only have 2 pricing tiers, and then we could just lower the customer acquisition costs. I think let's go that route and try to simplify it a little bit. So let's say 2 pricing tiers. No variability of price within each of those tiers.
I mean, there is the monthly yearly difference, but that's it's not like usage based or.
So we know, I gotcha. And that's an input we can change as well, billing versus annual versus monthly. In a bit, we'll get to that one. So we know that 100% comes from marketing or word of mouth as opposed to an outbound sales team. How many new opportunities do you generate each month? So the way we're defining an opportunity is a lead that's already been qualified by your marketing or sales team, and you would think of as a legitimate prospect. So in this case, you don't have a team of marketing and salespeople. You are the marketing and sales team. So whenever you think that a prospect is, qualified, how many of those do you feel that you get each month?
Like how many, you mean people subscribe each month?
So it's not necessarily new customers. It's just new kind of prospects into that pipeline or that funnel.
Yeah, I'm not really sure like how to properly qualify. Actually, wait, we can make an estimate. I'd say, can I count like all active premium users as prospect there?
Yeah. We can, if that's how you think most people get kind of.
I mean, only like a small subset of them, will end up using it, but
sure, yeah.
So let's say I have about 1.3K new active users per month, or actually at least that properly tried the product, and then maybe like 3% end up converting. Wait, that's less than the number that actually subscribed. That's weird. I don't know what's reasonable there, to be honest.
Well, okay, let's say this. How many new customers do you get each month?
100.
100. Okay.
Like in the past month, it's around 100.
So let's say that out of the things that someone can do, sign up for a freemium, and that's paying customers, right? 100 new paying customers. So let's say that
roughly like 2.6K people that register every month, but then like some of them they don't even actually use the product or
Right. Okay. Well, I think that those 2.6K qualify as opportunities.
Sorry.
Oh,
I think my iPod just died.
okay.
Give me 1 sec. Sorry.
Yeah. Okay. So yeah, I think that, and you said 2.6?
So 2.6 is like, the total number of people that actually submit the register form.
Mm-hmm.
Like,
Yeah.
and
I mean,
some, but like half of them don't even create a form. So like they
right.
don't manage to, go through the onboarding, or like they don't, I don't know, like multiple reasons.
Okay.
So
So maybe let's cut that in half and say 1,300.
yeah, I could say that, I
Okay.
guess.
How much money in marketing spend, digital ad spend, things like that are you spending
Um,
right now?
so I didn't spend anything up until like 1 or 2 months ago, where I started to do, some experiments with Google Ads, and I'm
Mhm.
spending, I'd say, like in the past 2 months, maybe if we average it, let's say 800 per month, something like this.
Do you think that going forward, it's going to stay in the next few months? Do you think it's going to stay around that number?
That's a big question, but I guess we can leave that. Yeah, let's say 800 or like.
Okay, let's go with 800, and let's see what happens. So I'm curious to see if this is going to what the model is going to do. I'm very curious about this. So anyway, this screen is just kind of explaining to the user that you have when you're dropped into the product and you look at all of the inputs that you're supposed to change, you'll have the kind of default FlowCog symbol for any inputs that are still a default. If you've edited an input, you'll see the user symbol. There are some constraints on some of the inputs. Some of them need to add up to 100% or can't be zero. The kind of one of the benefits of this being very specific to the SaaS industry is that there are these kind of suggested range heat maps for some of the inputs. They're going to look a little bit different for your product than a traditional B2B SaaS product that has a annual contract value of, $12,000 a year. Those retention rates are going to be different, so we will make sure to go in and adjust the inputs for those facts. Okay, so the model is ready. Typically, what I like to do with a user that's not doing financial modeling on a regular basis is to do the tier one inputs. Tier one is just kind of like the most important inputs in the model, then check the outputs, and then move on to the tier two. But because we're going through this together, let's go through maybe tier one and tier two together before we look at the outputs. Again, tier one is the most important. We know that we don't have sales development reps, so these are zeroed out properly. So we can say these are reviewed. These should both be zero. They are. These are our price tiers, average annual deal size going forward. Let's see if it got that right. $19 or $20 times 12 is $240. But then the $50 a month, that ends up being higher. So that's about 600 is 600. So let's change that. Okay, so we've changed those. Retention rate, it put it in at 65%. So the idea of, if you had 100 customers at the beginning of the year, how many are still left at the end of the year? And that's paying customers. Would you say that it's about 65 of them? Would you say it's more, less?
Let me find that. I guess I have the info somewhere.
So this would be over a 12-month span. So if you look at
12
your
months.
customers from December, like the total customer base in December, how many
I
do
have
you
like
left?
58% left.
58%. Okay.
Yeah.
All right. So let's use 58%. And again, that is not uncommon to see for a SaaS product that has a lower average contract value, or an average annual contract value, because for a couple of reasons, I think when customers pay more, there's a little bit more skin in the game. They're more willing to try to get value out of the product.
Don't worry, like I'm aware.
Okay, yeah, I didn't want you to take offense to that you're at the bottom of the
I know. Like
range.
it's kind of, and also, like my audience is kind of like, it's not really B2B, it's more like kind of for consumers, like in between
Yeah,
B2B, B2C, which
exactly.
also doesn't help with that.
Right. Okay, so those are the tier one revenue inputs. The expense ones, we have, let's leave these for now. So we said that total marketing spend, we're saying $800 a month, and we're saying we're getting 1.3K
That's premium.
leads in the door. So yeah, a little bit less than $1 per lead. So I think those are fine for now, and we can go back and change those. Those are important inputs to get right. But let's say that we've reviewed that for now. And then 800, we like that number. Okay, let's go to headcount. Oh yeah, there's headcount is going to be in tier two. We'll get to that in a second. Projected equity raises. I don't think we can put one in just to see what it looks like if you want, and we could put that in multiple years from now. The model does go out 5 years into the future. So if you want to do that, we could.
I don't have any plans for that now.
All
So
right.
like, don't worry about it.
Let's leave it blank. So we're on to tier 2 inputs. Let's work our way back. Let's go to headcount. So right now, the model already knows to zero out a bunch of these just because of the level of ARR. It looks at it and says, okay, you probably don't have a business intelligence department if you have 2 full-time employees and you're at, a couple $100,000 in ARR. So zero that out. Same thing with all of these, which I think is fine. I think we can kind of keep that way. Unless you're really thinking about building this out into a much bigger company, but if you're gonna stay small and scrappy, I would say that maybe one thing we could do is add in some developers along the way if you think that that's a thing you'll do. Like, so for instance, if we wanted to hire a developer every 12 months, we could do that and cut this salary down. Or we could turn it off entirely. That's up to you. Let's do this. Let's say that you hit an ARR milestone. So let's say every 2.5 million of ARR, if we get there in the model. I don't know what the model is going to say, but let's say that it starts to project revenue. Along the way, I'm sure you'll need some extra engineers.
Yeah, if I make 2.5 million, I'll find one for one.
Yeah. Okay. So let's leave that for now, but let's keep all of these others zeroed out. I think that's fine. Expenses I'm guessing we do not have any professional services. It's zeroed that out because the price point is pretty low to offer ongoing services. Yeah. The cost of the product, I think so there's a couple different ways of thinking about this. Do you have any
I'm trying to find, I recently did, like a very shit model to just basically list revenues and expenses. I just need to find it.
Okay.
It's about 400 per month, like total cost. If we not counting number. Sorry,
say that again. 400.
400, yeah.
Okay, and that's across you said 870 customers?
Yes, that's it.
Okay. So that's very low. That would be like 50 cents a customer. Let's be conservative and say $1 per customer. And then we're being conservative because we're increasing the expense. And then we could choose to leave this zero, or we could set it to something, but the software also gives you a choice to add in a variable cost as a % of your MRR. But if there's no kind of server cost that scales in the same way, or you're not having to spin up so for instance, if you were providing a paid Notion account to your customers, then that would go kind of in this section. But I'm guessing that they already have to have a paid Notion account and everything. Okay. So let's leave that zero. We'll say $1. Okay. So it looks like we're good with these expense inputs. Actually, let's go back to equity and debt for a second. This would be where you'd put in any term loans or debt that you plan on taking out. Even if it's a small one, we can do something like that. We could do it far into the future. If you don't plan on taking any debt, we can leave it zero. And then tier 2 revenue inputs. These are going to be important for sure. So let's say that we have financial results for the month of November. The conversion rate from open to closed won is going to be important. So this, I think, is where when we say we have 1,300 opportunities, as we defined it in the onboarding question, we said that typically you only get 100 paying customers a month out of the 1,300. So we would want to take 100 divided by 1,300 here and say that your win rate is going to be about 8%. Again, different because this is not just a B2B SaaS company. It's kind of somewhere in between, right? And this doesn't mean you're a bad person. This doesn't mean that your business is really awful.
I'm not taking this personally. Like, don't feel the need to make it soft. I'm fine. Thanks.
Okay, so we know that we don't have any ongoing professional services. Those are zeroed out. We know that we don't have any variability in deal size. We talked about that already. You don't charge a setup fee to customers. That's easy. We can keep that zero. We don't really have a setup phase even. So we can keep that zero. Upgrades and downgrades. This is an interesting one. Do you see upgrades at all?
Yeah, that happens. I do have upsells, but I don't know if I have an easy way to properly measure it. Let's say I have an average on the last few months of $150. The difference between the two plans is 30. Then I guess I have like 5 upgrades.
Upgrades per month on a customer. Okay, so that would be on 870 customers, right?
Yeah.
So you get about 5 a month. Okay, that's pretty low.
And then
Mhm.
downgrades, I have like 1 downgrade per month.
So let's zero out the downgrades. For the upgrades going forward, do you think that you're going to add kind of like significant value proposition for a user on the lower pricing tier to upgrade? Is that the plan, or is that not really in the
I have
cards?
features that I know will make the more expensive plan more interesting, but I don't know if that will increase the overall upsell conversion.
Mhm.
Maybe it will more likely, just get I'll just get more people choosing the higher plan, I guess.
Okay. Let's let's say that instead of, because the percentage would be pretty low. Let's leave this as a 5%. I think that's okay, and we can see what the model looks like, and then we can go back and edit it if it's a little bit too aggressive. So we've completed all the tier 3 or tier 2 inputs. We're on to tier 3 now. Annual increase in product list price. So do you plan on raising prices for new customers each year? Or do you think you're going to leave that price flat or relatively flat?
I've done it once so far.
Okay.
I don't remember when it was. I increased from like 15 to 19. So
Okay, that's kind of a pretty big increase.
So that's like 25% basically.
Yeah.
On kind of the same on the more expensive plan.
Okay.
Honestly, I don't know. Like
Mhm.
I like round numbers, so like I'm not thinking of changing the price anytime soon. At
Okay.
least not in the next few months.
Let's so when we look at this on kind of an annual basis though, if you say that you're gonna, let's say that 3 years from now, what do you see your pricing? What do you see your price points at, right? If you think that it's going to be around the same, we can put this number, we can zero it out or put it pretty low. Or we can just have like a modest increase each year of maybe, a 5% increase
Yeah, we
in
can do
price.
that.
Okay.
Let's do that. Let's do that.
Okay. This one is a little bit tricky. So there's if you remember, for the tier 1 input, we said that the retention rate we were going to say is 58%. So that's the probability that a customer that was here 12 months ago is still here today. Do we think that over time there's a benefit as you add more features to the product, that 58% is going to be at a higher starting point for future starting companies, for companies that start into the future?
Maybe because like the features I'm gonna add are gonna be like stuff like custom domains. So I guess if you did the whole setup of setting up your domain, then maybe you're more likely to stay.
Okay.
But I don't know. Like maybe
Well,
you can set it to something small.
yeah. So, I mean, this 3 percentage points represents, so, 12 months from now, a customer starting in December of 2023, instead of just having a 58% chance to renew each year, they would have a 61% chance to renew. And then if a company starting in December of 2024 comes along, they would have a 64% chance to renew. So does that kind of make sense?
Yeah, makes sense.
Okay, so let's leave that one. There's a very similar one, which is the longer that a customer is with you, the more likely they are to keep renewing, because presumably they're getting some value from the product. So I like to think of it as, if a customer's already been with you for 36 months, the odds are that they're getting value from it. They're going to stick around. I have this, it kind of defaults it to 2 percentage points for the size and maturity of your company, but we can lower this, and this is on an annual basis. So again, if a customer starts in December 2022 and they're still here in December 2023, we're saying now that what started off as a 58% probability to renew each year jumps up to a 60% probability to renew. Is that reasonable, or do you think it's higher than that?
Yeah, it sounds reasonable.
Okay.
I'll get there.
Let's say for open to closed one, let's say that all of the conversions happen maybe 1 month later. They use the product for a month. as a freemium customer, and then they convert 1 month later. And that matters for cash flow timing and everything, and how long it takes for, marketing dollars to go all the way through the funnel to then produce a paying customer. This is what we talked about earlier: annual or monthly contract portion, percentage of customers that are on an annual contract versus monthly. Maybe a better way of thinking about it, instead of thinking of your entire customer base, because maybe that percentage split was different throughout the history. What about customers that are signing up today? So for instance, the customers that signed up in the past 30 days, did most of them stick?
Yeah, most of them are like monthly, definitely.
Okay, so let's say only 15% of customers or 16% of customers are on an annual contract, and the other 84% are on monthly.
Yeah, that was reasonable. Probably it's even less than this, I guess. I don't know. Actually, I do have some on this page. So probably like on the first page of the Stripe thing, I have like 4 out of 20 that are yearly. So
okay.
That's yeah. I think 16% is fine.
Okay. A third of the way through tier 3, yearly increase or decrease in the cost to acquire leads. This would be like your kind of marketing expense. Do you expect to get customers through word of mouth? And if so, that means that leads over time would become less expensive.
I'd say more expensive. Like, you know, if I find a new, way to acquire new customers, even if it means paying more, like I'd do it. So I'd say more expensive.
So let's be more conservative with our projections and say that it's going to cost 15% more each year. The kind of marketing spend, if you had to break it down, I know that it may not be so clear in terms of where you're directing the money, but if you had to guess how much of the $800 each month is going to acquiring customers in the lower pricing tier versus the higher one, what do you think that percent split would be? Do you think it's 50-50, or do you think that a lot of the ad dollars are leading to
most users take the cheaper one currently.
Okay.
So yeah, probably like 80% the lower pricing tier, I guess.
Okay, let's do that. So we have to make sure that this is adds to 100. Okay. This is the, and again, we can zero some of these out or kind of, hand wave them away because they may not be relevant to you. This one would be yearly increase in marketing spend. So that $800 is not going to stay flat. I'm guessing that probably, if you're saying that you're spending 800 a month or about 10 grand a year, do you expect, 12 months from now to start spending double that, or, 15 grand?
That wouldn't shock me, I guess.
Okay. Yeah. So let's see what that does to the model. These are dollars that are unrelated to customer acquisition, branding, dollars spent. I don't think you have public relations. You are the PR department. But we can zero this out if you want, or we can leave a modest amount in there each month just to kind of cover other marketing expenses. Up to you.
Yeah, I don't mind, like whatever you think is best.
Okay. Yeah, let's leave that in.
Reasonable.
We're going to skip over some of these just because we can go back later, and if expenses are too low and unrealistic, we can go back and fill some of these in. Do you work with any consultants or anything like that?
Nope.
Okay. And then software subscription expense. We know we have some of these. So right now the model is saying that you're spending, and this is probably way overestimated, about $1,400 a month in software subscriptions. What do you think your total kind of software expenses?
Software expenses, I'm spending 180.
180 in total.
Yeah, for SaaS product.
So that's including your subscription to Notion. That's including everything. Okay.
Yeah.
Like
so customer support, Profitwell.
Okay.
Pretty much everything.
So we know that we can.
Oh, actually, there's real full. Did I count that?
Sorry.
Actually, it just got, it's 280. My bad. No. Because I did another one last month, so it's 280.
280. Okay.
Yeah.
So let's say that 100 of that is on the product side, or on the cost of revenue side. So costs to service your existing customers. And then we can say that the other 180 are split maybe evenly between sales and marketing, R&D, and G&A. Let's say that these grow by, let's be conservative and say maybe 40% per year. And then we can come back and change these. And I know that we're spending a lot of time on the inputs, but we'll get to the outputs right now. So what else are we missing? Are we missing anything here? Oh, okay, we can abstract these away. Let's not hire. Let's leave these pretty high. This is just saying for every X number of individual contributors in a department, hire a manager, and then et cetera, et cetera. But we'll exclude that from the model for now. And so for every, let's raise these a little bit and not worry too much about those. Okay, so that's a lot of the inputs updated. Let's see what the outputs look like. Machine. Again, this may project a crazy amount of customers because it may see that it barely costs anything to acquire a lead. And even if you have, a 5% conversion rate from a lead to a customer, that's still, you're still getting a decent amount of customers each month. So I'm curious to see what it does. Right now in the background,
how many models did you do before, like to decide on all these input and stuff? Because there's a lot of things. Like, how much time did it take you? Like, how many models did you do before coming up with that?
A lot of them. Definitely a lot. This is part of it too, is understanding which inputs are important. And, we went through all of the inputs, all 3 tiers of inputs in just under 40 minutes. And, for other users, it's going to be more difficult to get some of these numbers. There's going to be more thought that goes into it. But for the most part, depending on the SaaS company and their approach to their sales and marketing funnel, I can skip through a lot of the inputs or zero them out depending on where their focus is. So we know already that we don't expect. So right off the bat, I doubt you're burning $50,000 a year. We know that because we've already discussed the expenses. So we can dig in and see where the model is going wrong. I am curious to see
it's probably because you added, the 90K employee.
That could be it. Yeah. That definitely could be it. Let's see what the headcount looks like.
But it's weird because we didn't pass 2.5 million. I don't know.
Okay. So it does hire engineers in the far future, but it also thinks that you're paying the 2 founders $250,000 a year each, which I don't think is true.
So, again, like I don't have a precise salary for myself because, as I said, it's kind of mixed. So I just because I need.
Yeah.
And then the full-time engineer it's 2.5K per month. Actually now, yeah. So that's, I don't know, that's 30, I think, 30 per year.
And these would be in the future, but we can change those.
That's the current one. So maybe we can say it would be more, I don't know.
So these are when they're starting in the year 2025 and 2026. Yeah. But we can lower them anyway. The 2 founders, let's say maybe,
yeah, I'm not taking 250, I wish. But
yeah. let's say $10,000 a year, just to see what
maybe like 50, because, now I live off 8. So, like I do spend some money. So maybe 50 is reasonable.
All right. Let's say 50. And then the co-founder, the other employee, let's say 30, or do you think that's 50? Okay.
Yeah, it's 30.
And we shouldn't have any termination dates. We can kick that far out into the future.
How did you build it? Like there's so many inputs. Like how does it work behind?
Yeah, there's a lot of inputs.
You have like a lot of sub models and then you sum everything up. How does it work?
Yeah, so that's basically how it works. It also, so the hard part of building a financial model that's credible with investors is really, like I said before, the kind of bottom up approach to it, to say, okay, what are your most fundamental units of activity for your sales and marketing engines? And then how does that generate opportunities over time? So you really have to capture all of that. And then once you kind of capture all of the new customers coming on board each month into the future, you need to do some sort of simulation to say, okay, what are the range of outcomes for those customers? And so that's why when we were going through some of the revenue inputs, you saw like the word probability show up. And that's because behind the scenes, it's taking in all the information and running a Monte Carlo analysis. It's basically flipping a bunch of coins and saying, okay, we think that this customer is going to have, an 80% chance to renew. Well, that means 20% of the time they churn. So you start to get a range of outcomes then on the revenue side. And that gives you more confidence that when you're looking at projections, you kind of know how wide the distribution is. Given those inputs, if you're way off with all of the inputs, it's still not going to be a very meaningful result. But the benefit of that is that you don't just have a single point estimate where you're saying, okay, our revenue next year is going to be this, and we don't know how much that's going to vary over time, right? So here it might be a little bit hard to see because it's, and let's see if we can change this to monthly. Because the band is pretty tight here, but this is your kind of ARR growth over time. And so if we're saying, okay, these are the projected inputs that we believe to be right over time, then, September 2023, you're going to hit $500,000 in ARR. That's kind of a lot of growth. I'd be curious to dig in more and see why that's the case. I suspect it's because we said that we're really juicing up the marketing spend over time, which is going to drive a lot more leads. Yeah, so again, that we have to take that with a grain of salt right now until we dig into the inputs a little bit more once we see some of these outputs. Right away, this LTV to CAC ratio looks wildly off. So LTV to CAC is lifetime value of a customer to customer acquisition cost. For B2B SaaS, it's typically anywhere between the number 3 and the number 5. Here, it's like, 10x that.
What's on the 71?
Yeah, so I suspect that's because the customer acquisition cost is so low. Now, to be fair, in some cases, I think that is not, that's not that crazy, just because you do have a freemium tier, which is giving you a lot of leads and that convert to customers that you didn't have to spend a lot of money acquiring. So I think there is some truth to having a much lower customer acquisition cost and a much higher LTV to CAC ratio than other B2B SaaS companies. Even having said that, though, maybe it shouldn't be in the 70s. Maybe it should be in the 20s or 30s. But that's something that we could go back through and see.
Also, it's weird. Like the LTV currently, it's like 320, which is basically half of what is shown here.
Yeah, so I would guess that that's maybe a difference in the net renewal rate, possibly. So right now we're saying that net renewal rate hovers around this 60% mark, and maybe that's too high. It could be that the LTV also takes into account the gross margin. Maybe the gross margin is a little bit too high as well. So right now we're saying the gross margin is 95%. Maybe that number is true as of this point in time, but maybe as you scale, it doesn't stay at 95%. Maybe it goes down to 85%. It's pretty typical for B2B SaaS companies to have anywhere in the 75 to 85% range. So 95% is ridiculously high. And again, we don't have a lot of other kind of costs on the gross margin side of things in terms of servicing the revenue, because we didn't build in any customer success representatives, which would affect your gross margin. So naturally, because you're kind of somewhere between a B2B SaaS and a B2C company, you will have a higher gross margin than normal, which is great. One thing that bothered me was we're still off on the free cash flow. I don't think, it updated. Okay. I wonder I think that's probably a little bit, maybe that's not too far off. But let's take a look at the P&L. So let's start in January of 2023. So this is basically saying that we have 26, 28, 30. These are the revenue numbers. And then down here, we have the cost of revenue. So yeah, you'll see, from January to May, you're growing your top line revenue from 26 to 34. And because we're keeping that gross margin about the same, the cost of revenue is only going up a very small amount. And that's because this 95% stays flat. So some of the things that jump out at me, the R&D is really low, and that's because depending on how we classify the employees, that's pretty important. So right now we have on the headcount section of the software, both of the full-time employees tagged as executives, which a portion of which gets allocated out to the other line items, but a lot of which is going to fall in the G&A category.
Okay.
But in reality, I think over time you'll probably have a higher R&D line item than this is showing. And again, this is kind of the SaaS formatted P&L. So if you look at any other SaaS companies, either public or private, or if you ask an investor or your board of directors, what should my P&L look like? Which line items should it have? This is the answer that you'll get. You need a revenue line item, cost of revenue, sales and marketing, R&D, G&A. So the model kind of does that automatically and shows you what it looks like into the future. Just for fun, I'm curious to see where this goes over time. Interesting, these big dips. That's probably a big tax payment once you start making more money. Yeah, so March. That's for US taxes. That's another input tucked away. It's a tier 4 input that I don't want to bog down users with, but that's in kind of the settings tab. But over time, if you look at the free cash flow, I mean, I'm sure you'd love to have a company that's generating 800 grand a month in revenue. I wonder how many active clients that's on. Let's see, ARR per live client per month. So this is saying that this growth, if we want to look at it on a quarterly basis, that by the end of, call it 2025, you're bringing in each quarter 3,000 customers. That might be pretty aggressive, that growth. So maybe, again, I think that's a function of the cost to acquire a customer being so low and the amount of marketing spend that we're doing, which is pretty high. So one way that I would probably try to modify this is I would go back and say, okay, let's raise the customer acquisition cost a little bit to make sure that you don't have as many new customers starting each month. Because, even by the end of 2023, we're saying that you're generating not only 100 new customers a month, but 220 customers a month, which is a lot of growth. And maybe that's accurate, but that's pretty aggressive. But at least if if an investor were to ask you, okay, how are you getting this growth in annual recurring revenue, you can show them all of these metrics and these graphs and data tables and everything and say, well, this is what we're projecting and we're confident in this because XYZ, we're adding these features and we expect, the word of mouth to really kick in. And so we think our customer acquisition cost is going to stay very low. And again, not just for outside investors or your board of directors. I know that doesn't apply to you. So it's more so for your own knowledge of when you can afford to invest more money into the business without spending too far ahead of revenue. Because that's obviously a mistake that a lot of companies make, is that they start to have some success and then their spending goes off the rails because they're excited that they're actually making real revenue. And then that revenue flattens out or plateaus after a while, and the expenses are continuing to grow, and then you start to burn money in the future. So, that's why I like to, look at a lot of the high level metrics. LTV to CAC for the unit economics is a really important one. Your net renewal rate or your net dollar retention is going to be important. I bet that if we raised the retention rate, this model would look very different, and your ARR would have a lot sharper of an increase. So, I would probably say that that's not a good idea to just juice it up just for the sake of it. You'd want to look at your cohort analysis and say, okay, is it reasonable that it's at 58% like we entered, or should it really be starting at 65% or 70%? So that is something that, you know, I go through with clients and make sure, hey, is this accurate? So anyway, I know I did a lot of talking. I'm curious to hear your thoughts about this.
I don't go that much into details, but it's really cool, you know, to see a model and to see, you know, the inputs, outputs, and the correlation between those